Good afternoon, folks, and welcome to the Real Vision Daily Briefing. I'm Andreas Steno from Real Vision, sending to you live on the heels of the US CPI report. The peak is in inflation, at least in my humble opinion. And that is also what we've been told, I think, by various surveys over the past month. And unless SMEs are not telling the truth, then I guess it is fair to assume that the trend is now down for the time being in headline inflation. But I've invited a couple of tremendous analysts to help us unpack the inflation environment and whether I'm right in this bold statement. So first of all, welcome back to the show to you, Darius Dale, founder of 42 Macro.
Andreas, what's up, buddy? How are you?
I'm good, and I hope you're good as well. And also welcome to you, Weston Nakamura, the markets editor at Real Vision.
Thank you. Well, how are you, gentlemen?
Good. I mean, guys, I'll give you the chance to comment on my slightly cocky message that inflation has already peaked. Darius, do you concur with that view? Yes or no?
Yeah, totally. So, I think it's very clear that inflation has peaked. I mean, if we could throw up a couple charts to kind of elucidate this from a data standpoint, Claire, if you don't mind, don't start 76. Starting with that one, we show all the sort of various key categories of headline inflation. So we saw headline CPI roll over 140 basis points when you look at it on a 3-month annualized basis to 9.2%. Obviously, still very high relative to the pre-COVID trend, but that's a pretty sharp deceleration. Foods inflation actually accelerated 90 basis points, so that's moving in the wrong direction. But clearly, what's driving the big rollover in headline is this big sharp deceleration in energy CPI off 100 or 830 basis points to 26.5% on a 3-month annualized basis. But to me, I think it's less about the headline that the markets are celebrating, and really it's about the dynamics in core. Claire, if you throw up slide 77 as well, we saw core CPI roll over 100 basis points on a 3-month annualized basis to 6.6%. Now, per Charles Evans, who spoke after the report, he's the Chicago Fed president, still unacceptably high at 6.6% relative to the pre-COVID trend of 2.1%, but obviously moving in the right direction. And what I thought was the most important in the inflation report is this breakdown we saw in core services inflation off 150 basis points to 6.7%. So to answer your question, my friend, when you get breakdowns like this on a momentum basis, it portends very good news on a go-forward basis from the perspective of the year-over-year time series.
Weston, I will also allow you to unpack the market dynamics around this inflation print. What's been on your radar across assets?
Yeah, so I'm not going to follow Darius with that. So what I'm going to do is I'm just going to give kind of just this very broad cross-asset sort of reaction to what we had with the CPI print. And the reason is because, as I said on Monday, as I mentioned on Monday, so Jay Powell at the last FOMC, following Christine Lagarde, basically he killed off forward guidance, and he's saying that we are going to take this month by month, and we're going to take it meeting by meeting. And so essentially what that means is that if he's going to be data dependent, when you have data, especially CPI prints coming out, that is essentially the new FOMC, like Fed Powell press conference, if you will. If this is how he's choosing to express what the Fed is going to follow. So we had more or less a meeting or a press conference this morning, and markets were certainly sort of very much pent up for that, and you saw some significant moves, especially in futures markets, on some significant volume. And so, but before I get to that, I just wanted, before I forget myself, I just want to remind people that if these data prints are these sort of FOMC like press conferences, if you will, then we have to keep in mind that there is one more CPI print that will come before the next September FOMC meeting, right? So we have, I believe it's on the 21st is the FOMC announcement, but the CPI for this month is going to be on the 13th. So the way that I'm kind of looking at it, in terms of a month over month, the CPI today versus September is the month over month that really matters. But so with that said, just in terms of like kind of price action that really, caught my attention, obviously. So we saw a massive rally in NASDAQ futures were up 2% right upon the release itself. VIX cracked, below the 20 handle intraday today. And so obviously, equities, risk assets, Bitcoin, all that were flying quite high. In terms of the bond market, however, though, so 5-year break evens that fell back towards its sort of recent lows of 2.5. But 5-year inflation swaps, those inched higher to, I think it's about a little bit over 2.5, right? So slightly above recent lows. And those were kind of more in line with the Fed's like 2% PCE target, right? So I'm watching that, and I'm also watching the dollar. And so DXY broke the 50-day moving average, but it's not just a dollar sell-off story in of itself. Probably going to guess I'm going to be looking at the yen. It's also a yen buying story. We saw dollar yen drop 1.5% upon the release. Euro yen also dropped 0.5% or so. So this is also a lot of yen short covering as well, and basically people kind of closing out that policy spread between the FOMC or the Fed and the BOJ as well. So a lot of moving parts, but like I said, we still have PPI tomorrow. We still have another one of these prints ahead of that the next September meeting.
Darius, we have equities up, we have a weaker dollar, and we have slightly lower bond yields over the past couple of weeks here. I guess that's the textbook market reaction to the mixture of data that we've received over the past couple of weeks.
Yeah, no, I mean, to be very clear, I mean, the data we've gotten for July to date, particularly on the hard data front, or at least on the primary indicators, have been very clearly Goldilocks. I mean, if you look at, it sort of started last week with the ISM services print, big positive surprise. It was a very healthy print from the perspective of the internals, followed by the jobs report, which obviously was a gangbusters report. Whether or not you believe it or not is irrelevant from my perspective as a risk manager. And then obviously today we get this very dovish inflation reading. And so when you add those three factors together, it's pretty clear that the market's been trading like Goldilocks really since the kind of late June. And this is obviously we're getting kind of the river card here from an economic data standpoint. One thing I think that's been very instructive, at least for markets today, was this sort of breakdown in some of the leading drivers of core PCE. Claire, if you put that chart slide 79 up, where we show trim mean PCE inflation, median CPI, sticky CPI, and core PCE, and we're showing these all on a month-over-month annualized rate of change basis as opposed to a 3-month annualized. And the reason we're showing these particular indicators on a month-over-month annualized is because we think this is a market that's looking for the easiest, quickest path out of the tightening scenario. And so, we're trying to find the kind of the, when do these indicators get you to a level that would seem to suggest the Fed will be comfortable finally, instituting the famed policy pivot that everyone thinks has already happened. But I draw your attention in this particular chart on slide 79 to the two clusters of bars in the middle of the chart. Median CPI, which the Cleveland Fed maintains, that number declined 250 basis points to 6.3% month-on-month annualized. That's a sharp slowdown. And this is median CPI across everything in the broader basket. Now, obviously, at 6.3% month-on-month annualized, we're way north of the 2.6% trend we experienced in the pre-COVID era. But it's obviously a big move we've seen in the right direction. Secondarily, sticky CPI, almost equally as important as a driver of core PCE, decelerated 270 basis points to 5.4%. These are big moves. And the most important thing about these big moves is that they're happening outside of an actual recession. Typically, what happens in and around the business cycle is that you need the actual sort of, the decline in aggregate demand to cool prices, sticky prices, median prices, core prices, wages, et cetera. And we're not necessarily seeing the kind of traditional order of operations, if you will. We're getting the breakdown in inflation without necessarily seeing the real true organic breakdown in aggregate demand. And that's obviously incredibly positive for asset markets if you think about this and play it forward in terms of the Fed's reaction function.
No one's better at unpacking these details than you, Darius. I love it.
If we
go back to you, Weston, if we look at market positioning, I know that you've been looking into the dollar positioning, for example, versus the yen over the past month. How do you gauge the positioning in dollars and, for example, equities post this CPI report?
So in terms of positioning, what I'm looking at is so the yen, like I kept saying over and over again, is the sort of the Fed trade for many, just because of the fact that, front end euro dollar futures implied volatility is just astronomical through the roof. And so therefore, traditionally, when rates traders would make outright bets on where, Fed funds policy is going to be, and, at what level, at what time, and all that. At this point, with front end vol so high, what they're doing instead, what they have been doing, is just playing the policy divergence versus the BOJ. This static easing central bank versus a very potentially hawkish one. And so as that closes up or as that widens, that kind of gives more of a kind of a cleaner read, I suppose, on the overall market sort of view on that. The short yen position that was like very, very crowded over the last, let's call it 2 months or so, June and July, that has become much less crowded. However, there is still a massive outstanding position of short positions on the yen, but the yen has started to re-correlate back with something like DEC 22 euro dollar futures, which they used to move, in tandem with dollar yen. So that short squeeze, is initially over from that started with the FOMC meeting itself, then continued on through GDP that had U.S. in technical recession, so on and so forth. Then started reverse with the what Darius was mentioning, with the stronger services ISM and so on and so forth. So right now, positioning in terms of the currency markets seems to be still positioned for a stronger dollar. So if you start to see that unwind, it can actually, I think it could really cascade. I don't know at what point and from what angle. I don't know if it's going to be from the euro or from the yen or whatever it is, but they could trigger one another, and that could, seriously, even temporary or short term, it could seriously derail the dollar rally, and that can potentially be another sort of lift to risk assets.
If we look at the latest positioning data, I still think the yen is one of the most hated currencies worldwide.
Oh yeah.
While the positioning versus the euro is particularly more square than it is versus the yen when it comes to these dollar futures. I wanted to ask you as well, Darius, on the question of the dollar. Could this CPI report be a game changer for the whole positive dollar narrative?
Yeah, so I mean, so it goes back to, so what are the fundamental drivers of the dollar, right? The dollar tends to work in two specific scenarios. One, when the U.S. economy is accelerating very aggressively and outperforming the rest of the world, and two, when the U.S. economy is decelerating quite meaningfully alongside the rest of the world. Everything else tends to be a negative dollar event. This is what we in institutional finance call the dollar smile thesis, and that thesis is definitely born out of the data. When you think about the kind of dynamics that could perpetuate a breakdown in the dollar, you need to either see one of two things happen. One, a recovery in the global economy, U.S. and global economies. We don't think that's necessarily a high probability event, just given the lagged impact of tightening we're likely to continue to realize in the economic statistics. Secondarily, you could get a real material slowdown in the pace of deceleration. And that to me is kind of the new thing that markets have to discuss and debate, because you're talking about a very different set of, sort of annualized expected return profiles for things like the dollar, S&P 500 risk assets broadly. Going back to this discussion on median CPI and sticky CPI, I actually just put that chart back up, slide 79, Claire. The one thing I would call out is that, we've lost 250, 270 basis points respectively from those time series on a month-over-month annualized basis. So now we're at 6.3%, we're at 5.4%. If you just linearly extrapolate that kind of 250-ish basis point decline, we're going to be right around 4.5% month-over-month annualized for core PCE. That's a significant deceleration from where we were in the most recent month. Now, the key question for asset markets is, do we maintain this pace? Because if we maintain this pace, two extremely positive things are going to happen. One, we're going to get core PCE, the Fed's preferred, kind of inflation leading indicator, to break down to a level that's consistent with them, finally, sort of pivoting from the perspective of their policy. But more importantly, I think possibly equally as importantly, if we get that kind of sustained breakdown in inflation over the next few months, it's going to arrest the rate of decline in the U.S. economy. I mean, after all, a lot of the degradation we've seen thus far has been on a real basis, not on a nominal basis. And so you could actually sort of, create optical lift, if you will, to real growth just as a function of that decline in inflation, which again is very anomalous. And I'm rambling a little bit here, but let me just land the plane. If you throw up slide 89, we were showing the slide in 89. It's a very important chart. It shows the year-over-year rate of change in core PCE in the upper panel, and in the two lower panels, we show the 17-month rate of change and the 23-month rate of change. Why those two specific durations? Well, the Fed is targeting 2.7% core PCE to end the year of 2023, so 17 months from now. And then, being the nice guy that I am, I'm giving them an extra 6 months to get to their forecast. So that's effectively 17 to 23 months away. When you look at it on a rate of change basis, we've never seen core PCE decline the kind of decline that they have currently sort of baked into their forecast without experiencing recession. And so this goes back to my point. It'll be very anomalous relative to market and economic history for inflation to just break down like this without seeing that big breakdown in aggregate demand. But if it happens, it's obviously incredibly bullish. There's no ifs, ands, or buts about that. And bearish for the dollar.
Yeah, I think the Fed managed to create a soft landing during the early 90s, but that's right about the only time in history where they actually managed to do so. What's your implied probability of an actual soft landing now, Darius?
Oh, it's got to be higher. I think
Mm.
anyone managing risk in financial markets, looking at the kinds of declines we're seeing in these very key leading indicators, you have to acknowledge that the probability of a soft landing is much higher. And if we stick at -1 to 250 basis points in terms of shaving that momentum off of core PCE and core inflation pressure over the next few months, we will be very much at a place where the Fed might feel comfortable backing away. And ultimately, if we shave too much of inflation off, and again, it's not necessarily our forecast, we're just discussing the scenarios. If we shave too much inflation off between now and year end, the market's going to actually prove the Fed wrong on it. The Fed's own forecast that they won't be cutting rates next year. They won't be doing QE next year because it's going to look like they overdid it if you go into the end of the year. Two comments we got out of Fed officials today. Kashkari, who's suddenly out of nowhere become the most hawkish member of the Fed FOMC, said even after looking at today's data, which I'm not sure they've analyzed as closely as we have at 42 Macro, but if you're just looking at the headline, he's looking at the headline and says, I haven't seen anything that changes his view that they need to get rates to more or less 4% by the end of the year and continue hiking into next year. Same story with Charles Evans, the Federal Reserve president out of the Federal Reserve Bank of Chicago. So, the Fed could very easily, like if you continue to play this forward, there is a legitimate, plausible path to not only a soft landing, but to an actual Fed pivot where they're supplying the market with liquidity in 3 to 6 months. And I think that probability has gone from basically 0 2 months ago to something that's probably, gun to my head, 25, 33%.
If we take the market reaction at face value, it seems as if the market couldn't care less about these Fed speakers at the moment. So if we assume that we're currently trading the data only and not the Fed speakers, Weston, which kind of data points would you be on the watch for over the coming month or two in your trading perspective?
Yeah, just cross asset wise. So, but just to pick up on what Darius said about Evans, he also said that the markets are pricing in monetary policy credibility or concerns of that central banks will go too far. But again, like you said, as we were talking about, Powell is essentially, he's killed off this concept of guidance and all that kind of thing. So I don't know why they go out doing these speaking, engagements in the first place. So yeah, in terms of markets, something that I actually would like to get your view on, either of your, is the 2s10s curve, on the U.S. Treasury market, and the fact that it is, it's off of that minus 50 basis points level, and you had some volatility in moving around today, but that's still pretty deeply inverted. What do you guys think of that in the framework of a soft landing?
Andreas, you take it first.
Yeah, until a couple of weeks ago, I actually thought that this inversion could go even deeper. because I envisaged a kind of 70s scenario where we had 2s10s inverting to levels below 100 basis points, basically. And right now, I think the chance of a re-steepening of the yield curve has increased, alongside what Darius just mentioned on the increasing probability of a soft landing. I think a soft landing would re-increase the probability of a steepening of the yield curve. So I don't think it's crystal clear that the curve will continue to flatten over the coming month or two. But what I still hold as my base case is that the interest rate shock that we saw through the spring will prove to be big enough to simply kill off the momentum of the economy with a time lag. And unusual correlations, that time lag will kick in between late Q4 and early Q1 next year. So that's basically the period to watch if you are still on a recession watch. Over to you, Darius. Comments on this?
Yeah, no, look, so the one thing I would say, I tweeted about this a couple days ago, which is, when the 10s 2 curves inverts, that's when you start doing the research on recessions and trying to understand kind of the range of outcomes that you should anticipate as an investor. When the 10s 3-month curve inverts, that's when you need to start preparing for a recession, making sure your network on LinkedIn is doing well, et cetera, because that's the actual recession signal. And fortuitously for the economy and for asset markets, we have not inverted on the 3-month 10-year. And we're now starting to get a series of data points, whether it be on the growth side, as I mentioned, ISM services, jobs report, or on the inflation side. Today, obviously, both of those data points are really pushing you out of the direction of further spread narrowing from the perspective of both of those curves, or an inversion from the perspective of the 10s too. So, this is a dynamic and very fluid situation. 1 month does not make a trend in the data just as aggressively as we saw. Median CPI, sticky CPI, and more likely core PCE and mean PCE roll over as quickly in July. That rollover might not be as persistent in the coming months, and we might actually stick around 4.5%. Kind of from a core PCE annualized perspective. So there's a lot going on in the data. It's incredibly difficult to forecast. Because we're having a lot of things shock the model that historically have not happened. So it's hard to train the model on these kinds of dynamics. But I think the most important thing we need to do as investors is something I said last week, and I'll repeat it. We have to acknowledge that the distribution of probable outcomes, both economically and market-wise, has changed since where it was in June. And as a function of that, your portfolio construction probably should have changed from where it was in June. And if it hasn't, you're probably doing the game wrong.
Yeah, and in my humble opinion, there's probably a window of opportunity right now for both bonds and equities to perform in tandem, which doesn't happen that often anymore. I want to throw in a couple of questions from the audience because we have our commentaries on fire, basically. So let's start with a question from Bo. He's asking, if the NASDAQ entered a bull territory today, does that mean that we have a risk of a so-called triple dip recession? Any views on that?
Weston, you take that. I got nothing on that. I mean, those things are like non sequitur, to be quite honest with you.
if the NASDAQ basically pulled out of its bear market is the question, and then so therefore would that indicate a triple dip? Well, I'm sorry. What was the premise?
Yeah, a triple dip recession.
Based on
like
what
a tricky definition.
We haven't even had one recession. How are we gonna have a triple dip recession?
Yeah, I'm not sure. Yeah, I mean, so I don't know. I don't know really how to connect the NASDAQ price action to that per se from today, especially. But what I will say is that New York Stock Exchange, short interest data is showing that short interest has declined something like 3.5%, 4% or so, towards the end of July. So, I mean, a lot of this, what we're seeing right now, is not necessarily new longs per se, but it is short covering. And so there's a huge difference between exiting a position and putting on, new capital. So I would just be very careful about reading too deeply into something like, the NASDAQ and technicals with regards to whether or not it's still in bear market territory or what have you.
Yeah, one quick thing on this, just from a risk management perspective, don't pay attention to percentage change data or the moves and basis points, things that stuff is irrelevant from a risk management perspective. Performance data is literally irrelevant. if you're trying to do this correctly, you should be using, obviously different technical and quantitative indicators, but clearly price changes is not one of those inputs.
We have another question from Claudius in relation to the CPI report. He's asking you, Darius, whether you think the CPI print today will have an impact on your view of the probability of a new lower low in the S&P upcoming in Q4.
Oh, this without question that this report removes the left tail risk from the market. And the reason I say it removes the left tail risk, the sort of far left tail risk from the market, is because if you roll the cards forward, we're now in a discussion about, is inflation going to come down fast enough to cause the pivot, or is inflation going to come down fast enough to actually cause growth to bottom out and reaccelerate? Like, I think the discussion, let's call it 6-8 weeks ago, was, is inflation going to stay sticky enough to cause the Fed to keep tightening for longer than was currently priced in the markets? And I think that particular kind of bear case scenario, you might have to put to bed. I mean, it's very clear we're moving in the right direction, and not only moving in the right direction, we're moving in the right direction with some real severe expediency. Like, again, we just lost 250 basis points from median CPI and 270 basis points from sticky CPI on an annualized basis. Like, this is the kind of stuff that's never happened before outside of recession. So we're in a new game, and we have to acknowledge that.
We also have a question from Angus in relation to the so-called shelter costs in the consumer basket. Darius, I know you have a chart on shelter costs with you today as well. Angus is asking, Angus is asking us whether the Fed will look through sticky shelter costs if the rest of the CPI index starts decelerating. What's your view on that?
Yeah, so I thought it was pretty interesting that we had such a big drawdown in core inflationary pressure, core CPI, median sticky CPI, even though we still saw the continued acceleration in shelter inflation. Slide 78 shows our model for OER, which looks at the spread between home price appreciation and OER, and historically peaks in that spread have tended to presage 18 to 24-month accelerations in shelter inflation. So the model suggests that shelter inflation should be somewhere around, should be peaking in the first quarter of next year. So is shelter inflation going to be a thorn in the Fed's side? Absolutely. And this is, and this is why I say, you can't just go all in on the bull case here and expecting the kind of breakdown in core inflation momentum we saw to continue, because once you start to remove some of the core goods disinflation that we're seeing from the easing of supply chains, and obviously we saw a pretty significant drawdown in energy. You can't expect that every month. Maybe some people do expect that every month, but we certainly don't expect that every month. You might get to a place where we plateau at something like 3.5% to 4% core PCE, core CPI on an annualized basis, and that's not good either, right? Like we're doing what the market is celebrating, moving in the right direction at a very, very rapid pace. That very rapid pace may not continue, and we could be right back where we were in June as it relates to a Fed that is that's clearly getting more tight relative to consensus.
Angus is also asking Darius whether it's fair to assume that the Fed is on top of shelter costs, actually lagging the economic cycle by, say, a year or a year and a half. What's your take on that?
Yeah. I mean, the one thing I would say about shelter CPI, so we all know that it lags from the perspective of how it's collected, but it's also, I mean, you can make the case that that's not a, we sort of all in the financial community seem to be dismissing it as if it's like, oh, it already happened. But the reality is it did not already happen. Like, when we see price changes in things like computers and, things like airplane tickets, those things are actually happening in real time. You log online, you try to buy a new TV, you try to buy a new computer, you try to buy a new airplane ticket, you will see the price reflected. But the reality is we're not all changing our lease contracts, our rental contracts every month. And so the reality is there needs to actually be a lag to account for the fact that human beings don't renew their leases every month. And so there's, that lag is technical, but it also is partially fundamental. So I'm not sure that we as market participants or the Fed should be just dismissing it like it doesn't matter, because it is fundamental.
I think that's a very, very fair point, Darius. So I guess to sum up on today's inflation debate, it seems as if this left-hand side tail risk in equity markets has at least somewhat dissipated after this inflation report. It was quite a strong signal that inflation is now fading, even in median and sticky measures, which is an interesting development compared to just a month ago, where everybody was talking about higher and higher inflation. And in regards to inflation, most of you out there know that I've made it my trademark to conclude the daily briefing with a meme. And today I made a small contest on Twitter in relation to the best inflation meme out there, and I know we have a few candidates that we can bring up on the screen. First of all, we received a bunch of good candidates. This one with a picture from Jim Carrey saying there is a chance that inflation is now fading. I think that's a very fair meme. But secondly, we also had a fun meme comparing Maslow's hierarchy to the current bull environment, because essentially at the very bottom of Maslow's hierarchy, we have, of course, the need for a bull market. And maybe today's inflation report will actually give us the chance to get that bull market back. At least it seems as if investors, they find 8.5% inflation to be different from back in March. Darius, it was a pleasure to host you again. Thanks for joining.
Always a pleasure, my friend. It's all about the rate of change, brother.
Yeah, it is. And also good to see you again, Weston.
Likewise. Thank you, gentlemen.
That was all for the daily briefing today. My colleague Maggie Lake will be back tomorrow with Harry Milandri guesting the show. Thanks for watching out there.